Good morning. My name is Mirha Kahingunga and welcome to Corporate Strategy. I am your tutor for the day. As you can see on the first page, on my cover page, are my contact details. My number is 081 760 6079 and my email address is also there. It's mirhak@outlook.com. Corporate strategy. Corporate strategy is defined as the overall direction and scope of an organization and the way in which its various business units or operations work together to achieve particular goals. As you can see on the slide, on the slide that's on this page, that corporate strategy consists out of different business units working together to achieve a specific goal. Now, each and every organization has its own goals set in place. Strategic management is a part of corporate strategy. It is defined as the process whereby all the organization's functions and resources are integrated and coordinated to implement formulated strategies. Now, a strategy is an effort or deliberate action that an organization implements to outperform its rivals. A company's success and failure can only be marked against its strategic objectives. To cope with a changing environment, managers actively participate in strategic management. Strategic planning includes what type of business should a company be in? Who should its customers be, or what is its target market? It includes setting objectives and deciding on a mission or a purpose for the organization. It also includes evaluating the environment within which it must operate, defining its key stakeholders and determining its competitive advantage, formulating detailed strategies to accomplish its aims, as each organization has its own aims. Strategic planning also includes adding value, adding characteristics to a product or a service that the competitor, the customer, or stakeholder cannot do themselves. Corporate and strategic plans. These plans concern the number and variety of service, product, or of a service or a product market in which a corporation will compete. It concerns the development of the resources required to support the competitive strategies, concerns future needs and how to achieve and develop the desired businesses, services, products, and resources. Functional plans are derived from corporate strategy and strategic plans and relate to implementation on functional strategies. Functional plans cover specific areas of a business. These plans may be plans relating to product development, product control, and cash budgeting. And these are usually reviewed and updated and become ongoing or rolling plans. Strategic planning. It is defined as the managerial process of developing and maintaining a viable fit between the organization's objectives, resources, skills, and its changing market opportunities. The aim of strategic planning is to shape and reshape the company's business and products so that they yield target profits and growth. Since most organizations are the main target is profits and growth. On the next slide, we have strategic management. Now, strategic management is split up in three parts. We have the planning, the implementation, as well as controlling. Within planning, there's corporate planning, divisional planning, business planning, and product planning. Once the planning process has been done, then we move on to implementation. Implementation within the organization, or the organization itself implementing its what it has planned to do. And then the third part of strategic management includes the controlling. Controlling includes measuring results, diagnosing results, and taking corrective action. Planning the gap, also known as gap analysis. Gap analysis refers to where do we want to go and where can we go realistically. This is a question that's asked within a business. Where do we want to go and where can we go realistically. It's a strategic tool to planning. It compares actual performance with potential performance. Knowing where you are and where you'd like to be as an organization. It provides a foundation of measuring investment of time and human resources required to achieve a particular outcome. That can, if you want to just read more about the gap analysis, please refer to your corporate strategy book on page 80, the textbook on page 80. The strategic gap analysis, as you can see in the graph on the slide, on the vertical axis, we have sales. On the horizontal axis, we have the time or the number of years. Practically, what does this mean? It means that we are comparing, looking at the gap analysis, we are comparing where we are now, which is the current portfolio over here, and where we would like to be, which is the desired sales. Now, just to touch a bit on the definitions, a gap, which is the difference between where we are currently and where we desire to be, that which is called the strategic planning gap, is defined as the difference between a desired outcome and an actual outcome, meaning that we are comparing where we are now with where we would like to be. Now, when it comes to the gap analysis, strategic gap analysis determines what an organization should do differently to achieve a particular goal by looking at the time frame, management, budget, and other factors to determine where the shortcomings are. After conducting the analysis, the organization should develop an implementation plan to eliminate the gaps. Going back to our gap analysis graph, we'll see that the gap is a place between our current portfolio, what we are doing now, to the desired sales volumes, which is where we desire to be. Now, there are different ways to fill the gap. We have diversification growth, integrative growth, and intensive growth. These are the three measures that can be taken in order to reach your desired goals, or an organization can reach its desired goals. There are different types of strategic planning techniques. Some are relatively heavy on data collection and analysis of quantitative data. Strategic planning reduces risk in decision making, and it also helps in decision making. It depends on the validity and reliability of the data. We're going to look at portfolio analysis. There's one very famous means of analysis called the Boston Consulting Group Growth Share Matrix. This share matrix is a chart created by Bruce Henderson for the Boston Consulting Group in 1970. It was created to help corporations with analyzing their business units and other product lines. It's used as an analytical tool in product management, strategic management, and portfolio analysis. It consists out of 4 quadrants. The first quadrant being the cash cows, which is over here. And then on your right-hand side, we have the dogs. Above that, we have question marks and stars. Cash cows are considered to be the more profitable type of business, which are low in cash usage, however, generate great cash. So meaning that this is the very profitable type of business. Or you can also refer to this as being a part of a business unit, profitable parts of the business unit. Then we have the dogs, which you can see there on the right-hand side. This is usually where the unit just break-evens or where there is marginal profits, meaning that when we look at cash generation, it is low. However, cash usage is also low. So it's break-even and marginal profits are generated here. Then we come to the question marks. Question marks are unprofitable. Now, the reason why I say they're unprofitable and, they're usually used for future investments is that the cash generated in these units are very low. However, the cash usage is extremely high. And then we have the stars, which are termed, where we break even or where profits are relatively low, where we have high cash usage or cash investment is quite high into those business units. But however, the cash that's generated out of those business units are quite high. Cash cows are the units where they milk and redeploy the cash flow. Looking at the dog, these are the units whereby that type of business should just be liquidated. The stars, that's where we strengthen competitive position in the growth industry, and question marks, invest as appropriate to secure and improve competition. Now, with this specific growth module, I have actually compiled a few slides for you, which you will then also, these slides will also be given onto you at a later stage. You'll get them in your notes where it is well detailed and well explained. Bruce Henderson, who is the one that came up with this specific growth module, actually said, to be successful, a company should have a portfolio of products with different growth rates and different market shares. The portfolio composition is a function of the balance between cash flows. High growth products require cash inputs to grow. Low growth products should generate excess cash. Both kinds are needed simultaneously. There are different types of strategies, which in this case are just termed as being grand strategies. There's external growth strategies, internal growth strategies, decline strategies, and corporate combination strategies. External strategies. We look at external strategies through diversification. Through diversification, a business adds new business to its current business. Diversification is concerned with extending the organization beyond its usual boundaries. Diversification allows for an attractive scope that provides opportunities for faster growth, greater growth and profitability, which also refers to cross-selling. Access to technology, resources and expertise. Greater economies of scale and lower costs. Stimulation of innovation through cooperation. There are three ways in which diversification is accomplished, which is mergers and acquisitions, joint ventures, internally and also internally funded ventures. We also look at growth strategies in the sense of integration. Integration involves gaining control over suppliers, distributors, or competitors to enhance the effectiveness and efficiency of an organization. Vertical integration, the acquisition of a company that supplies the organization with raw material or components, or services as a customer for the organization's products or services. Backward vertical integration, it is gaining ownership or control of an organization's suppliers. It aims to secure suppliers or supplies at lower costs than competitors. We also have what is called forward vertical integration, gaining ownership of retailers and distributors. Now, horizontal integration is when an organization seeks ownership or increased share over the value chain activities of its competitors. Internal growth, also known as organic growth. We're going to look at internal growth strategies. Internal growth strategies expands growth from within and expands sales of existing products. It aims at retaining existing clients by providing improved products and services while in search for new clients. It involves market penetration, market development, and product development. In this diagram, we are going to look at growth strategies. This is also known as the Ansof model. Now this Ansof model, you'll also see that in your notes. I have the notes that I have compiled for you. It is very well and detailed. It's very well explained. Now this Ansof model also includes 4 different quadrants. In the first quadrant, we look at market penetration strategy. Now, market penetration strategy, the main aim here is to sell more of the same product or services to the same target group, because we're looking at current products and current markets. In this quadrant, the organization might advertise to encourage more clients within the existing market to choose their product or to use it more. Within this specific quadrant, the organization might launch prices or other specific promotions to encourage sales. Within the second quadrant, which is called the market development strategy, we have current products in new markets. Here, new markets and new areas of market are being targeted. The aim is to sell more of the same product or services to different clients because you're entering into a new market. This could be, looking at the market development, the organization might be targeting different geographical markets locally or internationally. And different sales channels are used in this market as well. Then we go to the third quadrant, which is the product development strategy. In this strategy, the organization is selling new products to the current market. And then in the fourth one, we're looking at diversification, where a new product is being sold or is being presented to a new market. But then, as I said, you will actually find more of within the notes, there's a more detailed explanation of this Ansof model. Diversification can take place in related or unrelated industries. We have what is called related or concentric diversification. This is adding new related products and services to the product and services line. This enlarges the market share in an existing market. An unrelated or conglomerate diversification, this is adding new unrelated products to the product, services, or line. There are different types of deadline strategies. These are the strategies that are implemented when an organization finds itself in a vulnerable position as a result of poor management, ineffectiveness, and inefficiencies. Now, there are different types of decline strategies, such as retrenchment. Retrenchment is when a company goes through retrenchment. It reduces outgoing money or expenditure or redirects focus in an attempt to become more financially solvent. This is also referred to as layoffs, or whenever you hear that a company is laying off its employees, this is actually what we call retrenchment. Divestiture is the removal of assets from the books of a business. Businesses divest by selling ownership stakes, closing of subsidiaries, and the bankruptcy of divisions. Liquidation occurs when an organization is terminated or bankrupt. Its assets are sold and the proceeds are paid to creditors. Any leftovers are then distributed to its shareholders. Bankruptcy. An organization becomes bankrupt when it cannot pay its bills anymore, meaning its cash flow is not able to pay off all its creditors. Usually, bankruptcy is declared when the financial situation of an organization seems quite miserable. Corporate combination strategies. We have different types. We have what we call joint ventures. A joint venture is a business agreement in which parties agree to develop for a finite time, a new entity and new assets by contributing equity. They exercise control over the enterprise and consequently share revenues, expenses, and assets. Strategic alliances. It's a relationship between two or more parties to pursue a set of agreed upon goals or to meet a critical business need while remaining in independent organizations. And then we have what we call consortia. It's an organization of two or more companies with the objective of participating in common activity or pooling their resources for achieving a common goal. I have actually compiled one question for you, which is as follows. Question 1. This is actually just describes the situation of NAMDIB as at March 2009. NAMDIB, which is one of the biggest diamond corporations within Namibia, recorded no diamond sales in January 2009 and February 2009, placing its cash flow in an unfavorable position. Production holiday was the preferred option of several considered, one of which entailed shortening working days. The production holiday was most favorable because it saved on the costs of inputs into production, such as fuel, which is the biggest cost, vehicles, and electricity as well. The low diamond sales were a result of the global recession. Not all areas were shut down during the production holiday. Essential services such as the schools, the hospital, the seawalls continued to run. The global financial crisis has left NAMDIB deeply scared, pulling down its income level to below 50% of the projected income for the period since September. The company slowed down production significantly in December, this is now 2009, following dismal sales in November. NAMDIB therefore embarked on a voluntary retrenchment exercise in January 2009 to cut its staff by at least 600. About 578 employees applied for retrenchment and 520 applications were approved. Question number 1A. Was NAMDIB's performance influenced by the external environment or the internal environment? B. Which decline strategy was used by NAMDIB? And C. What other strategic decisions were taken by the management of NAMDIB to reduce costs? When looking at the scenario that is presented to you about NAMDIB's financial position or what they were going through in January, February 2009 due to economic or global economic recession, we are able to identify what the decline strategy was. Now, looking at question A, NAMDIB's performance was influenced by the global economic crisis because there was low demand for the diamonds, and these low demands for diamonds resulted in low diamond sales, therefore low profitability. Number B, which decline strategy was used by NAMDIB? NAMDIB used the retrenchment strategy. NAMDIB, as you can see in the scenario above, or in the question or the information that has been given through to us, NAMDIB embarked on a voluntary retrenchment exercise in January 2009 to cut its staff by at least 600. About 578 employees applied for retrenchment and 520 applications were approved. Therefore, the retrenchment strategy was used in this case. Question C. What other strategic decisions were taken by the management of NAMDIB to reduce costs? NAMDIB implemented a production holiday. This production holiday saved on costs of inputs into production such as fuel, electricity, which are the main which are the main ones that contribute to the cost pool. Now, strategic management is a very exciting part of corporate strategy. And, you know, even as you go through your notes, it is very important that you read through your textbook notes, as well as the notes that I've also given through to you, with understanding, that you understand the different strategies, that you also understand the different, you know, when it comes to setting up of aims and objectives and the mission and the vision statement, that you understand all of those, because corporate strategy is a very broad subject. And it covers many parts that you would actually really use or implement when you're in the business world. So what I would encourage you to do is read through the notes that I have given through to you, and then secondly also read with understanding, and also always refer to your case studies which you have in your textbooks. Make time to read through them, make time to understand them, because once you understand that which is written in your textbook and you understand the case studies, then it will be easier for you when it comes to your exams to actually put the theoretical into the practical. Thank you very much. We have come to the end of our corporate strategy session, and I wish you all the best. Good luck. Thank you.